This is a presentation that was given at the Canadian Association of Mutual Insurance Companies conference in Whitehorse, Yukon on September 10th, 2013. The topic of today is interest rates and your portfolio. Global Investment Solutions and myself, Bruce Friesen, the presenter, are here to explain how interest rates and the coming changes in interest rates are going to affect your portfolio. As background, Global Investment Solutions has been an affiliate member of CAMIC for over 6 years, and we do investment consulting, and we put on governance seminars which numerous insurance companies have sent their directors and managers to. Jeffrey Hand and I, my partner, look to oversee the portfolios and the strategy of your portfolios. Global Investment Solutions does not manage money. We're an independent oversight consulting firm looking at strategy and performance. This is a necessary role, as this may be breaking news, but money managers will not tell you to fire them or to add on another strategy or to change to a strategy that their firm does not manage. They stick to policy, even if it is not appropriate. We want to talk about that. We want to talk about interest rates in your portfolio. And one of the aspects of that is the T-score. The minimum capital test, as you know it now incorporates an interest rate shock test. This compares the duration of your bonds with the duration of your liabilities. If you handle how you adapt your portfolio to this interest rate shock test, it may be one of the first times that policymakers will actually save you real pain and real dollars. Because interest rates are about to become the next big deal in investments. Let me explain. I am from Winnipeg, and as a Winnipegger, one thing you know something about is floods. As you can see in this portfolio, there's a red flag around this stick and a line that goes along here, the height to which this sandbag dike has been set. The sandbags set by the amount and the height determined by the forecasters. The forecasters in Winnipeg, when it comes to floods, are very accurate. They're accurate to date and time and how high the flood will be. To not hear their warning is foolish. But why are we talking about floods when we really want to talk about interest rates, especially when we know that insurance companies don't pay overland water damage? Well, it's about being forewarned. This is a slide of the DEX Mid-Canada Yield. You can see here that it starts in 1980 and goes through to current times. In 1980s, interest rates were up as high as 18% and have come down for over 30 years to current levels, which are around 1%. But which way do they go now? Do they go up? Do they go sideways? Down? You've probably enjoyed some nice returns as these interest rates came down, and the positive effect to your bond price portfolio has been very nice. Guggenheim Partners, one of the money management companies that we follow, said in a recent report, in the current environment, we believe that the surest path to underperformance is to remain anchored to the past. And the past is declining interest rates. And to understand the effect of declining interest rates on your portfolio, we need to understand duration. As every kid knows, longer means further. Longer arm on your catapult means the acorn goes farther. In this case, what we're looking at is duration, but it's the exact same effect. More means further. Duration is a more mathematically correct way of measuring time to maturity, and is used to measure the effect of time on liabilities and on your bond portfolio. So let's look at this a little more carefully. This is math. If you look here, you will see there is a teeter-totter here with a fulcrum in the middle. This end over here is interest rates, and this end is bond prices. If interest rates move down, the bond price will move up. And as you can see here, that 10, 20, 30, the further out means you get more movement for the same level of interest rates. So here, close to 2-year duration, you will hardly get any movement. Out here, close to 30-year duration, you'll get lots of bond price movement for the same movement in interest rates. This was all great as long as interest rates were going down. But now we're at a point where interest rates are down and they could start going up. This is going to cause bond prices to fall. In the coming examples, I'm going to use basis points and percentage points. Just know that 100 basis points equals 1 percentage point. The duration equals the percentage change in price for 100 basis points change in yield. For example, if your duration is 4 years, so somewhere around there, and interest rates rise 100 basis points, the value of your portfolio goes down by 4%. If your duration of your portfolio is 10 years, your value of your portfolio will go down by 10%. We're going to go through this a lot, but it's just like the catapult. Just remember, more is further. So the question is, well, they can and they have. This is the 30-year U.S. Treasury yield here, and this goes back from 2007 to now. And you can see the interest rates came down, and then one day on Bernanke's comments, they moved up. Ben Bernanke is the chair of the Federal Reserve, and he made some comments of taking some stimulus away from the markets, and the markets reacted badly. In a very short period of time, they moved up 1%. So we know it can happen. If your portfolio is consisted of 30-year treasuries, you would have lost roughly 15% of your portfolio from that one-day move. The goal today is to present ways to prevent this damage of rising rates on your portfolio, because at 1%, the odds of rates going higher is very high. To look at another way, if you look at, this is your duration of your portfolio is 6.8 years. If interest rates rise 2% or 200 basis points, and you have a portfolio size of $50 million, you will lose roughly $7 million on your portfolio. So the question is, do you think interest rates can go back to 4%? If you do, get ready for some losses if you don't look for new strategies. Do you want to be the one who explains to your policyholders how you lost money owning government bonds? It will happen. And it has happened. Many of you saw recently, you saw some portfolio returns to your June reporting date, and you saw returns that were negative for your bond portfolios. We know this because we were getting phone calls from our clients. So when can it happen? Tomorrow? Next year? Where are interest rates going to be for a year from now? Well, we firmly believe that down is over. Up is the risk. They may go sideways, but eventually they're going up. Like the flood, it's not if the water is going to come, it's when. It's not if interest rates are going to rise, it's when. So what can be done? Well, we have options. Well, one of the options is to do nothing. We can shorten duration. We're going to explain this over the next few slides. And we can look at new strategies. We track over 175 money management companies in our database, and many have been calling recently with some new bond strategies. We are looking on behalf of our clients for ways to earn a return while mitigating risk of rising rates, and we look at these new strategies on behalf of them. The regulators say you have to have fixed income in your portfolio, and we need to find ways to comply with the regulations and still earn a rate of return. But you have options. So let's go through those options. Well, do nothing. Back to our Manitoba example, doing nothing is perilous. Again, do you want to be the one who explained how you lost money on a government bond portfolio? The other example, shortened duration. As you can see here, on the yield curve, 30-year bonds are paying just under 3%. One-year bonds are paying around 1%. So as you shorten duration, you're coming this way, the yield you get is going down. So at 30 years, you get 3.1%, or 2 years, 1.2%. The answer is no risk, no return. Again, thinking about that teeter-totter, we want to move down the duration spectrum. We want to be closer to the fulcrum point. However, as we do so, we lose the ability to earn a rate of return as well. But let's look at those options at the short end of the curve. 3-year Government of Canada's are paying 1.5. 3-year A-rated corporate bonds are paying 2.25. 3-year mortgage portfolio paying 3%. There's no high-paying options. This does not give you a lot of room for error. At 3%, if anything goes a little amiss, you'll right away be into the negative. But those are options, and we think they should be included in your portfolio for a portion of your portfolio. However, we can also look at strategies. So when you look at new strategies, you can look at crazy math. As we did in 07, there's all kinds of mortgage portfolios that had some crazy math involved, and when things went wrong, they went very wrong. Or we can look to the stodgy bankers. We know they make money. They look for proven solutions. They look for ways that they can repeat and repeat, taking the risks that they want to take, not risks that are shoved on them by the markets. Back in the 1960s, the space race was on. NASA was trying to get people into space, and one of the things they needed to do that, they needed a pen. They needed a pen that could write in zero gravity, write upside down, in cold, all kinds of different conditions they needed this pen to do. They spent millions researching, trying to make a pen solve this problem. What they didn't do at the start, and they did do eventually, was look for the proven solution. The pencil. The pencil worked in all those situations. It was the proven solution. And that's what we want to do for your portfolio, is not look to reinvent the wheel, but to look for proven solutions. So what are some proven solutions that we can look at that are outside the classic strategies? These are the new strategies we can look at. High yield bonds. They're lower grade, higher default risk, but if you own them in a well-diversified portfolio, they can prove a definite add-on to your return spectrum. Similarly, alternative mortgages, the institutional version of household finance. If you don't qualify for a house mortgage, you can always go to household finance and they will look at you as a potential lender. Same in the institutional world. There are lenders that lend on first mortgage basis, quality buildings, but for some reason, the banks do not accept this borrower. Alternative mortgage organizations will accept the borrower. However, mortgages today in those institutions are being written at around 10%. Proprietary trading is another one, and we're going to look at that a little bit, but really suffice it to say is opportunistic trading that used to be done by the banks, but due to the new Basel III Accord, that the proprietary trading has moved off the bank desk and into private money management firms. The last is credit arbitrage. And I thought as a way to look at proven solutions, rather than go through all of them in high detail, just to give you an example of one of them, and look for the one that we thought we could explain. This is not the solution, it's just one of the solutions. And it's not for your whole portfolio, but it should be a consideration for a portion of your portfolio. Let's look at an example. The Credit Arbitrage Zero Duration Fund. As I said before, this is just an example. This is not the solution, but it may be a possible part of the answer. To understand the Credit Arbitrage Fund, we need to understand how corporate bond yields are made. Corporate bond yield has two components: the yield of a similar Government of Canada bond, and the spread, which is the extra yield for the extra risk. For example, the Government of Canada bond is yielding 1.8%. A Schedule I bank like TD, BMO, RBC has to look at the spread they have to pay, which is currently around 1%, and together the yield the bank would pay is 2.8. So the 1.8% from the Government of Canada and the 1% premium equals 2.8%. Let's look at that another way. So here we have the term to maturity, 5, 10, 15, 25 years. This is the rate that the Government of Canada yield would have to pay. So in the 5-year, 1.8%, and this is the premium that the bank would have to pay. So in the 5-year, it's around a 1% premium, so they have to pay around 2.8%. So this is the premium portion, and this is the Government of Canada portion. We're going to talk about that over the next while. This is the chart you saw earlier where it showed the interest rates over time coming down. But if you look at it more closely, you can see in here we had a lot of volatility. Now, if you think back to your teeter-totter, that's a lot of movement of the teeter-totter up and down. Down was great, up not so good. So we want to look at that and look at that volatility, because from 18% to the next level, which was around 11%, the drop is 700 basis points, and that's great when it's a drop. But if we now start seeing rises like that of 700 basis points, thinking back to our money example, it's going to be very, very expensive. Well, let's look at, so that's part one. That's the government part. It's volatile. Let's look at the premium. So this is the premium for mid-corporate bonds. That would be the premium that a corporation would have to pay on top of the government mid-Canada yield. So this, you can see in here, this section here from 1980 to now, relatively stable, except for this portion in 07. And there you can see that although it spiked up, it came back very, very quickly, because the markets realized that managers were not going bankrupt, but rather continuing to pay their interest payments. So the yield for the most part has been very stable, between somewhere around 0.4 and 1.6%. So part two, the premium, is very stable. So if you want to get rid of the volatile piece, and we want to keep the stable piece, how do we do this? Well, let's look to what banks do. Banks hedge. They get rid of extra risk by hedging. Farmers do it. Banks do it. Farmers use it all the time. They will look in spring at their planting costs, and then look again at their what the crop could sell for at that point in time for a delivery in fall, and they will sell a crop that has not even been planted yet, because they know they can make a profit at that number. They can also in fall look at costs of the input costs for spring and buy their spring input in the fall. They use it to get rid of volatility. Banks do it to get rid of interest rate volatility, stock volatility that they don't want. They use hedging. This is not some fancy problematic thing. It's a proven way of doing business. They use it to remove volatility. So let's look again at the yield curve. Once again, this is the Government of Canada curve. This is the premium. Remember, this was the volatile piece for the last 30 years. This was the stable piece for the last 30 years. So what if we can make the volatile piece go away and just earn this piece? We can through hedging. So if we do that, however, at 5 years, you look over here, at 5 years, you can see we're only earning 1%. So we need to find a way to buy more of this so that we can get back to our 3% that we were earning by buying a whole bond. The bonus of this is that when we hedge away the volatile piece, the effect is that the duration goes to zero. This immunizes these assets from rising rates. So if you have a portfolio of bonds, you can look at this and say, we have our portfolio of bonds has a duration of 5 years. We have this strategy has a duration of 0 years. Together, our overall portfolio exposure is 2.5 years. And you can then look at that versus your liabilities, and that will, if that brings you closer in line with your liabilities, will help your MCT score. So we need to look at this as we go forward to say, okay, we have helped our MCT score, and we're going to make a higher rate of return with less volatility. So how do we do this? Well, essentially, you buy a whole bunch of the good stuff and very little of the whole bond. So think of this as the whole bond, where you have the Government of Canada yield, which is the volatile piece, and the bank premium, which is the stable piece, and this is a whole bunch of bank premium over here. So we want a whole bunch of the good stuff, the stable part, and not so much of the other. Both have risks, just different risks. The question is, which one are you more comfortable with? Government bonds or corporate bonds? The question is, does it work? This chart shows the performance of the bond fund managers for 4 years ending June 2013. This box here, the bottom line, is the worst bond performance portfolio. This is the best performing bond portfolio. The darker line is the average. The red dot over here is the mortgage portfolio, 3-year mortgage portfolio. The green dot is the DEX short-term corporate bond portfolio. And the blue dot is the DEX Universe total return portfolio. The pink dot up here is the credit arbitrage zero duration fund. Made the most return while not taking any of the volatile risk. Over here, you can see on this vertical gray line, these are the 1-year periods that make up this 4-year number. So 1 year 2013, 1 year 2012, 1 year to 2011, 1 year to 2010. These 4 periods make up this number. So you can see that the pink dot was always positive, while you're seeing the blue dot has now, in the most recent year, dipped into the negative side. We want to prevent negative, we want positive. And so, although in 2012 this had a little bit of a hiccup, they earned it back in 2013, and the overall rate of return has been very stable, as you can see by the pink dots in the 4-year summary. Look another way, this is a risk return chart. So this, along the x-axis, measures volatility, and this measures rate of return. Where you love to be is up here, lots of return for very little volatility. And as you can see, there's no one there. The mortgage portfolio, very little volatility, 5% yield. Short-term bond portfolio has around 3% yield, but again, little volatility. The Universe bond portfolio has under 5% yield and some volatility. This portfolio has more volatility but a lot more return, while those around it got to that same yield by having a long duration. But as we said, that worked going backwards, looking backwards. But going forwards, if we think interest rates are finished going down and will now start going up, all these long duration strategies out here will be hurt. So what about the regulators? We know this works, we know it's a strategy, and new ideas need to be regulated just like old portfolios. What's the MCT impact? Well, we have started the process of discussing this with regulators. And the comments to them were, we understand your concern. We like the process you're using, the process of looking for solutions. They know interest rates are at ultimate lows, and they know that this is a risk to portfolio, but they like the fact that the company where we went to them with was using a process to discern what was going on and what risks were in these new portfolios and these new strategies. They also liked that the impact to the MCT was positive. In the case of the insurance company we went to the regulator with, by going to a zero duration, we pulled their weighted average duration down, and that brought it more in line with the duration of their liabilities, and therefore looked at that and said, and the mathematical calculation proved out that the impact of their MCT was positive. and they like that. But the biggest thing I think we got back from the meeting was they said, we like that you're not trying to surprise us. Coming to your regulator ahead of doing one of these new strategies is very important. A regulator will never give you a green light, but they will look at ways to help you with your decision and look at your process you're using and look for problems in your process. So there are decisions that need to be made. Is it time to shorten duration? Again, if you think interest rates are going up, then the answer is yes. The reasons to shorten duration are MCT risk, interest rate shock, what's the differential between your liabilities and bond portfolio durations, the risk of rising rates, as we said. Then the question is, which way do we shorten duration? Classic strategies, short bonds, short mortgages, or look at some of these new strategies. As we said, credit arbitrage was just one example. There are others. So what does this mean for management and the board? Management needs to educate themselves. Management needs to educate their boards and investment committees. You need to understand the interest rate impact to your portfolios. If interest rates rise 100 basis points, what's that mean to the value of your portfolio? What are these new strategies? Do they represent new risk? And can we mitigate the risk? How do we do this? Education is going to be a big portion of the obligations going forward of management and the boards. When it comes to governance, what are you looking at? Are you looking in the rearview mirror, like this guy, where you're looking at past interest rates always came down, bonds always go up, we don't lose money on bonds? Or are you looking over here and saying, what's ahead of us? Are interest rates going to rise? Or are they going to go sideways? What is the forward-looking ideas? Remember the quote, the surest path to underperformance is to keep relying on falling interest rates. You have been warned. The forecast may not be as accurate as the Winnipeg flood forecasters, but you have been warned. You have options, some better than others, but you have options. We've looked at them. Now it's time for you to understand them. Because the question is, are you prepared? Like this farmhouse that has the sandbag dike, when the waters came up, they were prepared. Their patio is nice and dry. Do you know the risk to your portfolio of rising interest rates? Remember, your investment manager, is sticking to his policy. You need to remember this. Forewarned is forearmed unless you ignore the warning. Thank you, and please call if you have any questions. Thank you.